In a number of the markets that has been a topic of discussion. It really depends on the markets in which we're active. In the end, we have a responsibility to keep the banks safe for all of the people that are customers of the bank. Of course, we want on the one hand to grow the number of customers. On the other hand, we want to keep the bank safe, and that means that you look at your balance sheet and the composition of the balance sheet in different countries. So in some countries, and we've seen it over the past number of years, we've seen the loan to deposit ratio shift downwards, so that we have in some countries more deposits than loans, and in those cases you're more careful with increasing deposits. If you want to grow your customers and you have not so many deposits, you may start with marketing rates. So we apply different interest rates for different situations, and we will continue to do that. And as regards to governments, I think it is unwise to interfere with interest rate policy of the banks.
Very clear, especially because there's talk about a bank windfall tax in Netherlands right now. Let me just ask you how you're thinking about the economic growth environment and whether you see any signs in the system that perhaps this monetary policy tightening that we've spoken about is beginning to have an adverse impact on the ground.
Well, what we do see is that the GDP growth in Europe is decreasing. We see that already in this year, where growth and that depends on the country in Europe, is between 0 and 1%. And also for 2024, we expect growth not to go back to the mean average, let's say, over the cycle. And what we do see in our loan book is that although, of course, we have a good deposit growth coming in, we have good fee growth, what we do see on the lending growth, which is typically around 3 to 4% per annum, this year is around 1 to 2%. So there is less loan demand at the moment.
Interesting. And what about just loan impairments? Are you seeing an uptick in that? Are you provisioning for that potential?
We don't see that much as yet. Currently, our non-performing loan percentage is 1.4%. That is the lowest since many, many years. As you well know, we have a loan book of 650 billion, of which about half is mortgages, largely in the northern Western European countries, which is low risk. So we don't see anything as yet, but we need to be careful because typically, also with higher interest rates, it takes a number of months, if not years, for risk costs to emerge.
Yeah. So I've been covering European banks for many years, and the question that analysts always ask is, you know, what are costs looking like? And the cost-income ratio, all of that is a big focus if you look at bank valuations. I know that ING have been very big on this path towards digitization. How have you prioritized your spending on digitization versus the desire also to keep your costs low?
Yeah. Well, in the end, it's not a dilemma because you can do both. In the end, what we do, we want to be a digital leader here in Europe. We have 37 million retail customers. We are being seen by many of the clients in our countries as the best bank in terms of the Net Promoter Score or how they like our services. And in the end, what we continue is to digitalize end-to-end, not only the front but also the end. And it goes in both ways. If you improve the customer performance, you can also digitalize at the same time and therefore lower your cost to serve. And what we've seen, for example, when using chatbots in call centers, the response of our customers is more positive in a number of circumstances than when they're serviced by a person. So we can do both at the same time.
So where are you seeing the biggest growth opportunities right now then, when you think about your business?
Yeah, and I mean, if you look at retail banking, in many countries, we have a good position. There's still ample room to grow. In Germany, we have 9 million customers, for example, but we want to grow to 10. We want to diversify our business a lot more. Still, about 80% of our business is linked to interest rates, and we want to increase our fee business. And once we have more customers and we do more with our customers, we can also build new businesses with them. And in wholesale banking, we need to strengthen and further strengthen our network, our sales and product drive in the different countries, and also work on our capital velocity because that will keep our capital down. Those would be the main levers.